Thank you, everyone, for attending today. For those of you that haven't met, I'm Nathan Davis. I'm a senior wealth advisor and chief investment officer here at Aspen Wealth Management. And what we're going to go through today is our quarterly market update. We're going to review the last quarter. We'll review year-to-date market performance, economic expectations, some of current events that we've seen that may be impacting markets and the economy. And we're gonna frame all of these talking points around some common client questions that we've been getting recently, and a lot of that is how it ties back to your assets, how it ties back to client portfolios. And we'll wrap all of that up with summarizing, hey, with all of this data that's out there, all the headlines, all the news, what are the actual implications for investors? What do you do with all of that information? So whether that's asset allocation considerations or your ongoing portfolio management considerations, if we're following the news, how do we summarize that up with the implications for investors? So we'll start with a summary on the short end of how things looked for the quarter. Historically, it was a well above average quarter for all of our major asset classes, with the exception of global bonds, which underperformed its average quarterly return a little bit. The US stock market overall, as measured by the Russell 3000, was up 8.18% for the quarter. That is relative to a 2.5% average quarterly return. We did finally see a little bit of a swap with international developed stocks, which overall year to date had done quite well relative to the US stock market for the third quarter. Underperformed US stocks at 5.33% for the quarter, still above its average quarterly return of 1.8%. Emerging markets really saw a bounce back, 10.64% for the quarter, relative to a 2.7% average quarterly return. With the bond market, we're finally starting to see continued recovery at past the 2022 interest rate rising regime and what that has done to the prices of our bonds over that period of time. And now we're finally getting to, on the back end, reap the benefits overall of having those higher rates, which is more income off of the same bonds. US bond market was up 2% for the quarter relative to a 1% average quarterly return. And global bonds, they still weren't a detractor in our portfolio. They still contributed with about a 0.5% return for the quarter, but that is short of the average quarterly return for global bonds of closer to 1%. Overall, we were comfortably between. This wasn't the best quarter. It wasn't the worst quarter for any one of our major asset classes. It was, for the most part, a steady march up without, too much interesting going on, at least for the quarter. Looking back a little further on what we've seen over the past year, so that's the past rolling 12 months, and then taking that out a little further, equities have outperformed across all of our time horizons, with the US stock market consistently leading, especially over the 1, 5, and 10-year periods. I do believe year to date, international markets are still outperforming US stocks, but when you factor in the US outperforming in this most recent third quarter, and then you factor in the fourth quarter of 2024, in the last 12 months, US stock market is now slightly outpacing international stocks overall. Very closely matched to what emerging market stocks have done over the last year. 17.4% for US stocks, 17.32% for emerging markets. What you'll notice here is that we don't have a lot of detractors in our portfolio over these longer time frames. Global real estate is still down over the last year. Just as the interest rates have risen, we have finally started to see quite a lag effect on what that has done to prices in real estate. The number of days of inventory on market finally seeing some price corrections in other places and less extreme examples, kind of just moderation of prices where maybe they're not rising anymore, they're just holding. And then over a 5-year basis, the only asset class we're seeing as detractors on our portfolio has been those US bonds. These are annualized returns, not cumulative returns over those 5-year periods. So thanks to 2022 and the interest rates rising as quickly and as extremely as they did, the price drawdown we saw through the end of 2022 into the beginning of 2023, U.S. bond market as represented by the Bloomberg Barclays U.S. Ag is down 0.45% per year for the last 5 years. Any time frame beyond that, we see 10-year, 15-year, 20-year rolling periods, positive returns across the board for all of these major asset classes. Looking at some of the headlines that we see for the quarter and what that means for the actual market performance, we do spend a lot of time talking about how these headlines are not offered up to explain market returns. Instead, they serve as a reminder that investors should view daily events from a long-term perspective and avoid making investment decisions based solely on the news. The news has a job to do. They have to report on something every day. And then a lot of times, particularly in the economy and financial markets, it can be aiming to create headlines and news where there's not really anything that's actually noteworthy. As you can see for the quarter, we have a lot of potentially very negative headlines here, and it was still just a good quarter overall for market returns. But looking at some of these mixed headlines that we had kind of earliest to latest, overall, global equities climbed pretty steadily, although there were mixed headlines. Markets climbed early July through late September. The gains were supported largely by, trade agreements. So some of the uncertainty around tariffs starting to wrap up. We've seen economic resilience and easing interest rate pressures with rates starting to come down again for the first time in September. Early gains for the quarter were largely driven by trade optimism, solidifying and finalizing some of those trade deals for the U.S., both with the European Union and Japan. And so what was in earlier quarters being treated negatively in markets was the concern about the potential of escalation of trade conflicts by reaching those deals. Any concerns around further escalation, at least with those markets, was largely wrapped up. We did start seeing mixed economic signals overall. June inflation, and we'll spend more time later talking about inflation. June inflation rose to 2.7%, which was the kind of beginning of this trend of inflation moving in the wrong direction. In August, we started seeing job growth softening. There were only 22,000 jobs added. And with jobs data in particular, we've started to see, while corrections on the back end, when we get further and further away from the data, corrections were always common. There was definitely an escalation of the degree of adjustments to the jobs data that added some uncertainty there as well. But overall, central banks helped ease some of the market concerns. The Fed cut rates for the first time late in the quarter, as we said. The Bank of England started delivering rate cuts as well, even though their voting was a little bit tighter than what the Federal Reserve had. Not everyone agreed over there that they should be cutting rates. Some other headlines that we saw, AI headlines definitely reemerged. NVIDIA, AMD started offering discounts to maintain chip sales momentum amid some of the tariff trade pressure. Geopolitical and policy tensions remained. There was a stalled Trump-Putin summit, what was at the time looming government shutdown risks that became very real government shutdowns that we will talk about here in a moment. And a lot of that was tied in with weak economic signals out of China. And so despite all of that noise, where it covered the whole spectrum, there was company-specific noise, there was geopolitical noise, there was government shutdown risk noise. With all of that, markets pushed to record levels on multiple occasions. Dow closed above 46,000 for the first time. Gold rallied alongside equities. And so all that to say in conclusion, the third quarter of 2025 was a classic climbing the wall of worry environment where markets advanced on easing macro pressure, resilient fundamentals, even as the headlines that we saw throughout the quarter were a steady stream of uncertainty. Just to remember that we need to always make our portfolio decisions with a long-term lens and not getting caught up in day-to-day price movements of the stock market or day-to-day headlines that try and explain what's happening with markets overall. So to our government shutdown, with what we know so far. The government shutdown began at midnight on October 1st, 2025. So that puts us right now at about 23 days of shutdown, which is already one of the longer government shutdowns that we have historically had. The reason that the government shuts down, Congress fails to pass a funding measure, either one that is just a short-term continuing resolution or full appropriations before the new fiscal year began. And so negotiations since then have remained stalled. Some of the key upcoming votes, some of the upcoming political schedules that we're going to keep an eye on. So the Senate is expected to vote again within the next week on a House-passed measure to fund the government through November 21st. That bill, that kind of stopgap measure, has failed multiple times in the Senate since it was first proposed. And so back at the House, they're largely out of session this week as members are in their own district work periods. And so that has slowed progress quite a bit. There are sources in the White House that believe that the shutdown could be resolved within the next week if some sort of momentum shifts. But overall, the sentiment seems to be the possibility of a prolonged closure. So estimates, well, all of this is very volatile, just like estimates on trying to guess what the stock market's going to do over the next month. But the prediction markets have largely suggested, shorter durations where, if we were looking at 30 days on the longest, but there also kind of seems to be a two-part measure with that November 21st date in mind, that if something in the next week is not passed to get the government reopened between now and November 21st, it could lead to, on the other side of things, the government continuing to be shut down till November 21st, at which point in time it wouldn't be negotiating a short-term stopgap measure. It would more so be, a long-term budget measure. And so it's a kind of a twofold expectation of what could happen with the duration of the existing government shutdown. All that to say, well, government shutdown, how does that actually impact markets? How does that impact my portfolio? With our investment implications, what we are looking at here is a summary of previous days around government shutdowns. And it takes market returns, and you see the line through the middle with the start of the shutdown, and it kind of brings it back to a scale of 0 to help us explain leading into government shutdowns and on, day 1 or 0 of the start of a shutdown. Shortly thereafter, what did markets do leading into and leading out of, or at the beginning of a shutdown, to say what could we expect to see from markets with where we've been here so far. Historically, what the data shows us is that government shutdowns have been much more of a political event than a market event. They can delay economic data releases, which can temporarily slow growth, just while all of the market participants kind of have an increasing amount of uncertainty of what's actually going on with our economy, what's actually going on with the data, if there's any of those releases that are delayed. But they have rarely had a lasting impact on corporate earnings, which is a component that actually matters for pricing and valuations in the stock market. They have rarely had a lasting impact on market returns, as we can see here. I wouldn't say that what we need to expect going forward has to exactly follow any one of these paths. But as we've seen in the most extreme example was back to 2018, which as of right now was the longest government shutdown that we had seen. Markets did worse leading into the government shutting down. And when you brought returns back to center it on day 0, market returns were actually positive going out of of the shutdown. It was a matter of weeks before we got back to previous market levels in that longest shutdown that we had seen. So market behavior since 1976, there have been 20 shutdowns total. The median duration of those shutdowns was just 4 days, however. So we are well beyond that already. During those periods, the S&P 500 averaged a 0.1% return during the shutdown. Looking past the government reopening and new spending bills being passed, 3 months later, after the government reopens, 2.6% positive return 3 months later on average. And then when you fast forward 12 months later, post reopening of the government, on average, there was a 12.6% positive return heading out of a government shutdown. So, very little indication that there was any sort of lasting effects of government shutdowns on markets in the economy, not to say that there isn't a lasting impact on the government employees who are actually impacted with their pay and their benefits as a result of the government being shut down. So, we can say markets tend to look past shutdowns because they really don't affect private sector earnings, the direction of monetary policy. Any volatility that we see is usually driven by uncertainty, not by actual any sort of economic damage. Of our economic and operational effects, it's just some of that data delays that can cause issues. If CPI data is delayed, if jobs data is delayed or is postponed, it just increases short-term volatility because visibility is reduced. GDP impact, it can, each week of a shutdown may reduce GDP by about 0.15%, looking back at historic periods. This because an important part of GDP is government spending. These losses historically have been recovered within the next quarter, and in the most extreme examples, it took 6 months, it took 2 years. And then, as we said, with pay being delayed to federal employees and contractors, they tend to be made whole post shutdown. But some of the essential services, including debt servicing, do continue without interruption. Even if some of the paychecks aren't going like they should be, there's a lot of essential services that are continued. So short-term effects are concentrated in some of the government-facing sectors. They do not materially affect corporate profits or long-term economic health. Putting all of that in context of the market in 2025, the 2025 shutdown risks arises amid what was already heightened political division. There was already been broader macro uncertainty as it pertains to tariffs and what our inflation changes have been, and are there continued to be lagged effects built into inflation. All of that was already present prior to this shutdown. What it may do to markets is kind of short-term swings in sentiment. I didn't include it this time. Last market update, we talked around sentiment and how it can translate to market returns. And for the most part, it needs to be largely ignored because when sentiment bottoms out, that tends to be when you get the best returns following. But it may trigger short-term swings in sentiment and investor behaviors. But overall, I mean, it's not a debt default scenario. The U.S. continues to meet its debt obligations, and that preserves global confidence in treasuries. So even the fixed income market that is so driven by treasuries, outside of some sentiment issues, not really an issue for portfolios overall. Kind of summarizing all of that into portfolio implications of the government shutdown that we are currently experiencing, we need to just stay invested. Long-term investors who stayed invested through these past shutdowns were rewarded overall. If you looked at markets from 2009 to 2025, the S&P 500 grew from 100,000 to over 1 million, despite multiple political disruptions. There were 3 to 4 government shutdowns during that period, and all of them were tiny, tiny blips on the chart of market returns over that phenomenal investment period of 16 years, because they really just didn't have any impact on markets. Markets persisted despite interruptions in our U.S. government. We want to avoid reacting to the headlines just because, if these events generate noise, it rarely changes anything long term from an investment outcomes perspective. And then we're just going to focus on quality and diversification. So the political uncertainty underscores the value of owning high quality companies, globally diversified portfolios. Those tend to be more protected from any sort of surprises that we see as part of our government. Looking back at some of those macro considerations that are still something that we want to keep an eye on and are more likely to cause issues in our markets going forward than something like the government shutdown that we're experiencing. Looking at inflation components, you can see over the last 5 months or so, we've really seen a trend reversal. After peaking at 9.1% in June of 2022, inflation has come down considerably over the last 3.5 years. When you look kind of short term locally, we have seen a little bit of an uptrend back. As of the most recent CPI data, which was August data reported in September, and CPI was sitting at 2.9%. Overall, with kind of expectations going forward for inflation, it does seem like the trend higher through year end and into next year is very possible. I've seen estimates as high as 3.5 to 3.7% for CPI into early next year, early to mid next year. And that's largely due to expectations that retailers will continue to grow the passing along of higher input costs as they continue to restock new inventories that have been affected by tariffs. The belief is with the lagging effect of tariffs, anyone that you're buying anything from already had inventory present in the US when tariffs were initially announced. As they sell off that inventory, as they need to replenish, their cost of goods sold is only increasing on a forward basis, not what they may have already had in stock or in supply. And so the belief is that some of those restocking of inventories is going to finally push the CPI a little bit higher, even than it already has. Those pressures may be amplified in early 2026. Some of it for good reasons. Americans love spending money. There's expectations that there will be, with the continuation of the Trump tax bill, larger than usual tax refunds in 2026 for 2025 taxes. The data would suggest that Americans get those tax refunds and largely spend them on things they don't really need. And so that increased demand can absolutely have an impact on our prices as well, more from a demand side than a supply side. The base case overall for economic estimates puts the year-over-year inflation to peak sometime in the second quarter of 2026, while the impact of tariffs works itself through the market. Energy and goods prices will largely contribute to that. Where the relief is being largely estimated for like I said, the peak being seen sometime in the second quarter of next year, is to allow what's been it hasn't contributed to inflation falling yet, but has started to hit a peak and work in the right direction, is the cost of shelter and services. The estimate, which those are a large part of the contributions to CPI as we see here, is that the lag effects of some of those lower or moderated costs on shelter and services will start to really pop off in the second or third quarter of next year, which would allow us to potentially see a peak in inflation overall, and maybe start heading back towards the Federal Reserve's targeted inflation rate of 2%, or if they change their target, trying to keep closer to 2.5%. From a portfolio standpoint, this does just reinforce the need of, we talk about diversification in a lot of ways, but maintaining both equity and fixed income exposure as part of our portfolios is an important part of staying ahead of inflation. Yes, stocks provide volatility to our portfolio when we're looking at short-term timeframes. But if inflation continues to be high, and particularly if it's higher than expected, equities in the stock market are the best way to outpace inflation for the long term. So, interest rate volatility could persist in the near term as the yield curve changes over time. We'll talk about that a little bit later. As the Fed decides if they are going to continue to cut, if they pause, particularly with them waiting to see what happens with not only inflation, but the labor market. And we won't talk much about labor market today. But overall, maintaining our equity exposure helps us stay ahead of these inflation surprises in the long run, knowing that we need to create a balance of the diversified portfolio in order to do so. So transitioning a little bit more to the equity side of things is a question we've been getting a lot is back on the bubble conversation, particularly as it pertains to, AI enthusiasm, as it pertains to tech stocks. The most notable, bubble that we saw in tech was kind of the onset of the new millennium, so the early 2000s dot-com bubble burst. And looking at kind of just understanding stock market bubbles in general. So bubbles generally form when stock prices rise significantly faster than the underlying earnings of the companies that they represent, that those stocks represent. So this disconnect between price and fundamentals is what typically signals overvaluation, leading to like what is a very good visual description of a bubble where it gets bigger and bigger and bigger, but it's unsustainable and it bursts. And you can't ever know that until after the fact of, is this a bubble or not? You only ever know after the fact, because if it seems that we're demonstrating the signs of being in some sort of market bubble, there have been all sorts of asset classes that have experienced bubbles throughout history. But looking at the stock market as our example here of are we in a bubble, there are typically one of two things or a combination of the two that can happen to identify if this was really a bubble overall. So there's always the opportunity or the outcome of what we saw with the dot-com bubble, and that is that the bubble bursts. Prices decline often sharply to kind of realign with the more sustainable earnings levels. As we said, the bubble is created when prices are going up and going up and going up, and the subsequent earnings aren't really matching and they're lagging behind. Your bubble can burst, stock prices can correct downwards quickly and get back to a more normal, appropriate valuation level. That's what we saw with the dot-com bubble bursting. There is a second scenario with what a perceived bubble today is. And that's where, in hindsight, you can only ever realize that it wasn't actually a bubble at all. It was just a mismatch of prices and earnings. And that is, earnings can grow to the point where they catch up with prices. So if the onset of a bubble is prices outpacing the level of earnings growth for any of those companies, the other option we have outside of a bubble bursting is that company earnings can accelerate and outpace price increases, where the valuation gap closes organically over time and earnings catch up to elevated price levels. In hindsight, if earnings catch up and continue to justify the higher prices, then what appeared to be a bubble may not have been one after all, just a period of stretch valuation followed by stronger fundamentals. Looking at what we have here in terms of AI today and relating that back to the tech bubble, looking at our earnings-backed growth, the companies leading AI adoption today are generating substantial profits and free cash flow. They're not relying on speculative funding. Since 2021, tech sector earnings have risen nearly 80%. And so while prices are up 94%, very different from the 1996 to 2000 dot-com period, where prices of stocks were up 439% on just 73% earnings growth. And so we have a much closer match today. While yes, AI shares have come up quite a bit from a valuation perspective, they also have the subsequent earnings growth to back it up. Where it doesn't mean that our price to earnings ratios aren't being strained a little bit, but it is not even close to a comparison of what we saw during the dot-com bubble burst, because there's just been discipline around capital expenditures for these companies, looking at the amount of actual expenses that they've had relative to their prices overall. Another thing that's been substantially different, and I think what a lot of these companies have learned thanks to being able to review the history of the onset of the internet and the dot-com bubble burst, is that there's been tangible demand. There's been real demand driving the investment in AI. Global data center needs are projected to grow roughly 20% a year. Data centers and building new data centers has been in the news quite a bit as a very large infrastructure investment. Data center needs are projected to grow roughly 20% annually through 2030, supporting a structural growth theme in AI overall. Another factor that's very different this go round is that AI is already contributing to our GDP. In 2025, AI-related capital expenditures accounted for 1.1% of U.S. GDP growth, outpacing consumer contributions and helping to offset softening consumption. So we know that AI is already driving U.S. growth. Lastly, just kind of with the comparative history, looking at those price to earnings ratios, the S&P 500 information technology sector in March of 2000 had a forward price to earnings ratio peak near 55 times. So prices of those stocks were 55 times the amount of earnings of those same companies. Today, it is nearly half of that. It is 30 times. Prices of those companies today represent 30 times forward earnings of those companies, which we will talk a little bit more in the next slide with how does this AI bubble potentially translate to the overall market. 30 times earnings is higher than normal, but it is not, kind of dollar for dollar expectations of what we saw with the dot-com bubble burst. What this means for our portfolio implications. Yes, absolutely, pockets of exuberance can emerge, but the broader market is not displaying the excesses of the early 2000s. Many of today's AI-related investments are embedded across many different sectors. Industrials are benefiting by AI, utilities are benefiting by AI, semiconductors obviously are benefiting by AI. So the exposure is more diversified than it was in early 2000s. It remains prudent to maintain a balance between growth and value. We're not going all in on growth. We're not avoiding growth altogether because we're concerned about a bubble. We want to maintain that growth and value exposure, value being companies that demonstrate more attractive, which would be lower price to earnings multiples, meaning that we are buying higher streams of expected earnings in the future for lower and lower prices today. That is kind of the antithesis of the growth market, of the AI market. We want to own both sides of the market, growth and value, rather than avoiding tech altogether or piling into tech and tech only. We want to make sure that we're creating a balance. So with how that translates into equities overall, and the follow-up question to the AI bubble that we get a lot is, are equities overvalued? Overall, valuations definitely are elevated relative to history, but it's not yet to a point that I would define as extreme when you contextualize that by strong earnings, the index composition overall of what types of companies, what types of sectors are making up the index, here being the S&P 500. And then just some of the structural shifts we have seen in capital markets over the last 5 to 10 years. Looking at our valuation snapshot, the S&P 500 trades at about 22.7 times forward earnings, which is the highest level now that it has been in the last 25 years. And this is the S&P 500 overall, not just looking to isolate tech or information technology or anything like that. The long-term average for valuations is 16 times earnings. Mega cap stocks, which is the largest 10% of companies, if you want to call it that, are 19.7. So looking at expanding past tech, Looking at the mega cap stocks, valuations are a little bit lower. If you look at value stocks, which, as we mentioned, are companies that by definition have lower price to earnings ratios, their earnings in the future are more predictable, and we're able to purchase them for more attractive values today. Value stocks are trading just 17.3 times earnings as a forward price to earnings ratio. And so it can show that there's a perceived overvaluation. If we're looking at the concentration of the largest companies, if we're looking at a concentration of AI focused companies, and we're comparing it to a long term average of what the total market overall would want to expect. But that overvaluation is concentrated. It is not market wide. There are plenty of subsets of the US market that are not experiencing those same heightened valuations. Not to mention, foreign markets as well, which across the board trade at much more attractive and lower multiples than what we see on average in our US market. So for some structural context, the index itself has changed. Tech now represents 35% of the S&P 500. At the time of the dot-com bubble burst, tech was only 15%. So when you figure, let's look at the S&P 500 valuation of the year 2000 and the S&P 500 valuation in the year 2025, the companies that are driving those higher and higher forward PE ratios, the valuation was much higher with a much lower concentration of tech than we have today. To further indicate that sector being extremely overvalued at the time. Earnings resilience. S&P 500 profits grew 10% last year and have now logged 3 consecutive quarters of double-digit growth, with margins nearing record highs at 13.6%. So there has been earnings growth. There's been resilience in earnings. It's just that prices are continuing to outpace that growth that we've seen with earnings. And then lastly, similar to the AI, with just some comparative history, even within the tech valuations, they're far below those, bubble levels. 55 times in 2000, as we said, versus 30 times, 25 to 30 times today. That we've seen specifically within tech. So for our portfolio implications here, while a pullback is always possible, especially after strong gains, valuations alone rarely trigger corrections. The more important determinants are earnings, direction, interest rate trends, and investor sentiment. Looking at data from JP Morgan with their kind of scenario framework of like multiple paths ahead. We will review that a little bit later. But it kind of spells out, hey, there's 4 paths overall that we could expect to see, and the valuation that we see here plays into that quite a bit, to help kind of set expectations with the other question that we get quite a bit, which is, well, what do we think is going to happen next with stocks, with bonds, with foreign and domestic? There's approximately 4 paths ahead. The valuations that we have today, very much play into that overall. So for key takeaways, AI is very much leading to some of these higher valuations, but it is also a considerable new source of productivity and economic growth. So it's not price increases with nothing to back it up. There are tangible additions that AI has already provided to our economy overall. Valuations are elevated. They're being supported by robust earnings. Corporate balance sheets are still very strong. They're managing their debt very well. But overall, we just want to make sure that we keep that diversification and balance when we are being intentional with how much of our equity portfolio is growth oriented, how much of our portfolio is value oriented, being mindful of our benchmarks, being mindful of the global market portfolio when we look at global stocks, what percent is growth, what percent is value, and how do we allocate our portfolios relative to that global market portfolio. Diversification very much remains the best defense against any of this valuation-driven volatility. So transitioning out of equities and touching on the Federal Reserve interest rates, inflation is a very important intro factor here, because the Fed focuses so much on inflation in addition to its labor market requirements. But overall, with our Federal Reserve outlook, there's still the expectation for gradual easing, even amid these mixed signals that we have seen. Mixed signals being, some changes in the labor market, some a movement in the wrong direction as it pertains to inflation, with inflation after trending downwards for 2.5 years, kind of starting to tick back the opposite direction. But in September, the Federal Reserve did resume its rate cutting cycle with a small cut. It lowered the Fed funds rate by 25 basis points, 0.25%, to a range of 4% to 4.25%, which marked kind of the first rate cut along the current easing path. We had rate cuts in the past, and then we stalled for a little while. Overall, the market expectations and what we see here in these charts is what the federal FOMC, Federal Open Market Committee, believes their estimates are for the path of rates. In blue, green is what the market expects, and it's the way you summarize what the market expects is largely around pricing of fixed income instruments and what yields things are trading at different maturities. So the difference between what the Fed themselves believes is going to happen with inflation, believes is going to happen with rates. And then the differences you see with market participants in terms of how they actually price in their trading and how that may differ from Fed expectations. But the consensus estimate is two more rate cuts at the two meetings through the end of the year, and then an additional two rate cuts for the first half of 2026. Again, these are just estimates based off of the current data. These do fluctuate quite a bit when we look out in quarter to quarter, of what market participants and what the Fed thinks. It's all in response to whatever the data continues to be and as the data continues to change. But based off the data as we have it today, two rate cuts through the end of the year, two more rate cuts in the first half of 2026, which would be the Fed maintaining a policy that is still modestly restrictive. Their actions appear increasingly data dependent. They are avoiding, the kind of the government intervention in terms of the path of rates, and they are trying their best to remain independent as they are supposed to rely on the data, make their own determination for rates and rate setting. And when that data dependency is based off of a balance of slowing employment growth and then still elevated inflation pressures. The Fed's own projections imply that inflation will remain above their 2% target longer than unemployment will remain above its long run 4.2% level. And so that's a dynamic that could complicate future decisions, because then you start talking about, are we potentially on the path for stagflation, which is, higher inflation, also coupled with lower and lower, if not declining, economic growth. They very much want to avoid that if we can. But this may create, with the rate cutting cycles that they've continued, even though the data has changed a little bit, it creates perceptions of political influence, especially in an election year. But we believe that the central bank is focused on maintaining a measured glide path back to neutral. Neutral being the 3 to 3.25% range for the Fed funds rate, at which point in time the expectation is for a pause on further cuts. That gets us a neutral rate that is well above the 0% rates we had for a very long time, which you see on our chart, of the 2008 to 2014, and then again with the onset of COVID, of federal funds rate that was slashed to zero. 2022 through 2023 is a very noticeable jump up in those rates overall. And so the estimate is if they can set their neutral rate back to 3%, it provides them good flexibility to manage rates in either direction as economic data may change. If inflation remains sticky or remains high, it gives them a good baseline where they could raise rates a little bit and try their best to keep inflation in line. or if inflation moderates down further, they could cut rates slightly or just hold if they needed to get it across the finish line. So the expectation is that neutral Fed funds rate of about 3%. Kind of looking ahead of the schedule, first week of November, second, third week of December are the next Fed meetings. As we said, the expectation is right now for 25 basis point, 0.25% rate reductions at those meetings overall. Definitely something that we'll be keeping an eye on. And so with that information, how it translates into our actual allocations for bonds, the best place to actually earn some income going forward in bonds, and what past rate cycles we could have learned to expect today from past rate cycles and where we stand. Um, Higher starting yields point to solid returns from core bonds going forward. As we talked about on slide 2 or 3, where US bonds are still slightly negative on an annualized basis over the last 5 years because of the substantial price drop that they experienced in 22 into 23 with all the interest rates rising. There is a benefit of rates having risen, and that's you earn more interest on those same bonds going forward. It just takes a little while to actually, generate the benefit of it. So with the discussion that we just had on a new, expectation for a neutral rate for the Fed, how that translates going forward, yields offer a very reasonable case for just a neutral allocation with our fixed income. There's plenty of money to be made in fixed income without really overthinking it. If we do see a combination of Fed Reserve rate cuts, if we do see some signs of a moderating labor market, some of those things have helped push the long-term yield slightly lower. That creates price returns in addition to continuing to receive higher interest rates than we did previously in those zero interest rate years. Looking ahead, it does seem like with the looking at more of a range-bound interest rate market where we've had some volatility in rates. The expectation is for that volatility to diminish a little bit. There's more expectations of slightly on the high end, slightly on the low end of where rates are today to stay range bound, to finally limit some of the interest rate volatility that we've seen, and just continue to collect income. As of right now, the current yield on the Bloomberg US Ag is 4.4%. That's not rates and forward rates that we've seen since the early 2000s prior to the great financial crisis. What this chart shows us is where are we starting with our yields, and depending on the day where yields start, what were the annualized returns over the following 5 years as you collect those coupons on the back end. And there's been in the past some volatility around that average line, but it shows the higher our starting yield can be, as long as it's not a significant interest rate increasing regime like we saw in the 70s, which is an outlier on our chart here with the purple, where rates did start in the 7 to 9% window, and we made less than that over the subsequent 5 years. The 2010s, where we see subsequent returns on both end of the lines, but it was also rates that started at zero or started at negatives. We appear to be in a very comfortable place with mid 4% current yields, and a very reasonable expectation to actually receive that total return over the next 5 years. And that is largely thanks to the expectations for interest rate volatility, the changes that we see in rates being diminished. We were hoping for just very quiet interest rate markets over the next 5 years. Interest rates are high today. Let's just collect those coupons for the next 5 years, and not have the price volatility that we've had in the past. All that to say, not all rates are created equal. It's not like every time the Fed cuts their rate, every single stop across the yield curve subsequently reduces their rates as well. When we're looking at current short-term rates versus like 1 year, 3 year, 5 year, 10 year, and beyond. Um, our strategy for allocating in a shifting rate environment, as the Fed Reserve resumes its rate cutting cycle, short-term interest rates, which, we would say the 3 month to 2 year maturities, they would decline most significantly over the next year, right along with that Fed funds rate. The shorter your maturity, the more likely you are to be influenced by the movements in rates that the Federal Reserve sets. Longer term rates, 10 years and beyond, the expectation is largely for those to remain stubbornly high, to not participate in the interest rate declines, thanks to the Fed potentially reducing their rates. And a lot of it is because the longer term rates have different influences than the short term rates do. Things like persistent fiscal deficits and what that's going to mean for our ongoing debt issuance as a country, sticky inflation, economic resilience, those are the driving factors for what to expect out of long term rates, as opposed to a point by point equal reduction in long term rates as the Fed changes their rates overall. And so the environment challenges the historical playbook where in prior cycles, Fed cuts typically lowered rates across the curve. But this time, what we're looking at here overall summarizes our yield curve steepening, is more likely to occur thanks to what's called a twist. So falling shorter rates and flatter rising long-term rates. We've had an inverted yield curve for so long, and that's where you see the zero line, the data points falling below the zero line, where short-term rates are actually higher than long-term rates. In a normal market environment, you'd see exactly the opposite, that you get compensated for longer and longer debt with higher yields at longer debts, longer maturities than at shorter maturities. And so the expectation is to see that yield curve twist where, yes, short-term rates could be falling, but long-term rates very likely won't participate in that. And then at the longest end of the curve, they actually may continue to rise slightly. As of, as of this quarter, the expectation is for the curve to continue to steepen meaningfully through 2027 even. So there's been quite a lag effect of prices and how that translates after interest rates have risen, as interest rates fall thanks to the Fed. And the expectation is that lag will continue almost another 2 years, even if the Fed stops reducing their rates in the second quarter or third quarter of next year. There will be lagged effects of changes in rates going forward, likely through the end of 2027. It takes a while for some of those changes to work itself through the market. Not to mention, there's more to interest rates on the long end, than just what the Federal Reserve is doing. So where we think the most attractive maturity range is for producing income in a portfolio, for providing the least amount of volatility, is in the 2 to 5 year maturity range. A lot of times this is called like the belly of the curve. There's a lot of volume there. There's a lot of issuance there, because we feel overall the yields are very solid. It just doesn't have the same interest rate risk that the long end of the curve has, where you don't generally want to own bonds as interest rates are rising on that part of the curve, as we all experienced in 2022. That is what leads to price declines. So in terms of, we have someone heading into retirement, where do we want to invest in their portfolio to provide a semblance of stability for the first 5 years of their retirement? Where do we want to go to generate attractive income? It is that 2 to 5 year maturity window in the fixed income environment. So the last part of questions that we've been getting a lot recently. It's always very funny, as the better crypto does, the more questions we get about it. Whenever there's a sell-off at any point in time in crypto, we tend to hear about it a lot less. But we do get a lot of questions on, what is the future of crypto? Does it belong in a portfolio? What considerations do we have for it? So, Bitcoin and Ethereum, cryptocurrencies overall, have started surging in the spotlight again in 2025. A lot of that price rallies fueled by there are now new ETF approvals. It is easier to access cryptocurrencies in normal portfolios now than it has ever been in the past. There's been rising institutional access, political tailwinds, all this. Clients naturally start to ask us, does crypto deserve a place in our portfolio? So for us at Aspen, our investment decisions are grounded in academic research, disciplined asset allocation, and long-term investor outcomes, not short-term expectations. And so, for a balanced look at the current case for and the current case against crypto exposure, a little bit on why we don't currently allocate to it, and then what would need to change for us to ever reconsider that and consider adding it into our portfolios. A few talking points. So the case for including crypto and why we get so many questions about it is just the historical performance. Even some of the most academic sources that we follow, their case for a recommendation of including crypto as part of a portfolio is that assets can go up more than they can go down. Something can go up 1,000%, but the worst it can ever go down is 100% and become completely valueless. If you allocate 1% of your portfolio to some sort of crypto asset, overall, from a portfolio return perspective, the worst that crypto could ever do for your portfolio is a 1% loss. The best, or a reasonable expectation is that you could earn 10% on your portfolio if you see a 10x in crypto prices over time. But that's always the extent of the thesis, is that it can go up or they can go down, and it is a volatile asset. What's the worst that can happen? There's not much more tied to it than that today. So when we're looking at the potential fours and why we get questions about it, is that crypto has increased in price quite a bit. Looking at the historic returns over the last 10 years is enough to take notice. Another argument for crypto and portfolios is the potential for occasional diversification benefits, and that's what we're looking at here. At times, crypto has shown low correlations with equities and low correlation with bonds. A lot of that breaks down in times of market volatility, and it would seem that as the crypto space gets more mature, as the ETFs become available, as institutional adoption increases overall, the correlations are starting to rise. Traditionally, in portfolio construction, you can add a risky asset to your portfolio and still decrease the overall risk of that same portfolio, and you're adding a risky investment to it, if the correlations or how the price and standard deviations of that asset move relative to what's already in your portfolio are low to negative correlations. That would be a academic reason for adding something to your portfolio if it has low or negative correlations. That justification has very much fallen off over time as correlations with traditional stocks, correlations with traditional bonds have increased over time for crypto. It's also important to note, I mean, with a chart like this going back to 2013, crypto was in its absolute infancy in 2013. So there was no adoption in institutional portfolios. The market was very, very small then. It's not unlike when we very much try to avoid putting too much credence in stock market data from the 1920s and the 1930s, because the stock market was so much different in the 1920s and 30s than it is today. It is a consideration, but it doesn't need to be a large one when evaluating stocks today. Even looking back at 2013 crypto price movements relative today, the market was in its infancy. We really struggle to take any of this price data from 2013 to say 2020 or 2021 and draw any conclusions from it as markets exist today, because it has grown so much. Overall, there's the theory that there is a low correlation to traditional stocks and bonds, but the data time frame for reasonable data is still a little bit too short. And then the last pro for crypto that we get a lot of questions for is it's just broader innovation, blockchain and the adoption of blockchain and how that ties in with crypto. is very much an innovative theme, that when you tie that in with some pretty significant improvements in price over time, it's attractive. Now, all the reasons against adding crypto in our portfolios and what would need to change for us to, reevaluate including it as part of our portfolios. There's been extreme volatility and drawdown risk in crypto. Drawdowns from 50%, 70%, very typical, even with the kind of large cap crypto, something like Bitcoin. On average, it's 4 times more volatile than the S&P 500. Another major issue for us is that right now there's no intrinsic value, there's no income. Crypto assets don't generate earnings, dividends, or interest like companies do or like bonds do. The prices are speculative. There's no identifiable valuation anchors. There's nothing to anchor back to like stocks and bonds. The comparison of, 2013 to 2020 crypto markets and how good is that data, and then tying that back to the 1920s and 1930s in the stock market. The market itself was in its infancy then, but what was very, very different about stocks at that point in time is they were still companies. They still had income statements. They still had balance sheets. They still generated earnings. That can't be compared with crypto today because crypto just doesn't have it. And then for us, the poor real world use in currency functions. They're rarely used in actual transactions. They're rarely used as actual currencies because of that price volatility. So the ongoing use cases are just really difficult. So all that to say is why we don't currently allocate crypto to our portfolios, because they're long-term portfolios. They're focused on demonstrable research and in data that we like to make sure is reliable. And we on our exposure to the larger digital innovation theme is largely through our exposure to U.S. equities. And so it's not that we exclude crypto due to unfamiliarity or trend aversion. We exclude it because of the data right now. It just doesn't support its role as a necessary or reliable portfolio component. So the last part of that is, well, what would need to change? We remain open-minded to emerging asset classes, to new things, to trends that are developing. What we would want to see is more predictable risk return behavior. Volatility in that asset class would need to fall substantially. It's not that we want no volatility. It's not that it can't be volatility that is higher than the volatility we'd expect in U.S. stocks. We just need to see a longer time frame of real, statistically significant volatility data for us to consider including it as part of portfolios. Clear valuation anchors would be a plus, like anything that's a recognized framework of intrinsic value outside of just speculating based off of a scarce asset that doesn't have much to show for it beyond that. We would need a valuation anchor to emerge to guide those allocation decisions. Reliable diversification and market stress. The correlations overall that we see here, yes, correlations to stocks and bonds are lower than many other asset classes out there. But when markets get stressed, those correlations really shoot up. And what's supposed to be a diversifier, a lot of times in the worst time for stocks and bonds, isn't much of a diversifier at all. And then the last thing for us is just stronger institutional custody and regulation. There's still very much a people problem in crypto, a company in regulation problem in crypto. That is, we would need to see significant changes to frameworks and institutional wallets, improved fraud protection, stuff like that, before it was ever considered as a possible part of our portfolio. So for us, the bottom line with the investment implications, it's very exciting. We always have fun talking with clients on outside of their portfolios with us. If you want to speculate on something, sure, it's a great asset to speculate. Crypto is exciting, but the excitement is not a substitute for, actual evidence, academic-based evidence for inclusion. It just doesn't meet a lot of the standards that we have today for inclusion in our portfolios. So, summarizing all of that for our implications for investors today, as always, we want to stay invested through the noise. Short-term political events like government shutdowns, tariffs, Fed speculation often create market headlines, but there's rarely, a justification for a change in your long-term investment strategy based off of that. History shows that remaining invested through this volatility has consistently rewarded patient investors. So we want to make sure to stay invested. Diversification remains your first line of defense. There's been mixed signals on inflation, policy growth, but no single asset class consistently outperforms. A globally diversified portfolio, meaning diversification across different types of stocks, bonds, real assets, it helps manage risk and smooth returns across different market environments. And then lastly, fixed income is relevant again, but we want to make sure that we stay flexible with our fixed income. Yields are now closer to a fair value. Bonds can once again be meaningful income sources. They can provide real downside protection. Investors should consider neutral allocations within your fixed income. Don't try and make too many bets on either end of the curve. Don't try and go too long. Don't try and go too short. We do, as we said, really like that short to intermediate 2 to 5 year time frame that matches up well when you're going to likely need to distribute off of your fixed income. Focus on the quality and flexibility across that subset of the sectors as some of those rate paths change and diverge globally. Not all parts of our yield curve will move the same. So appreciate you joining us today. As always, this is very general information. Every one of you has your own specific needs and concerns and considerations. So please, at any point in time, you can call, you can email. We are happy to talk about the specifics of any of your questions or concerns beyond just what we discussed today, which is always the general. So thanks again for joining us, and we are happy to help if there is anything that comes up.
Awesome. Thank you. Hey, Nathan, one thing that Tom had a question on that I think, and if you need to jump off now, this will be available as a recording. Tom, we'll get back to you on the crypto thing because that can just be a whole nother dovetail of conversations. But there was a slide, Nathan, on investment implications. And can you kind of delineate between the X and the Y axes again? Um, so his question was investment implications slide.
Oh, of the shutdown?
Yeah, I believe so. There we go. Yeah, the X and Y axis.
So the y-axis is returns, and then the x-axis is days around the government shutdown. So this would indicate like a drawdown of 15% heading into the day of the start of a shutdown, and then an approximately 13% rise after the start of a shutdown. It takes market performance leading into, which is the negatives on our x-axis, like the day one of a shutdown, and going as far out as 24 days post shutdown, because that's the longest one we've had so far. So with the great question with the y-axis being market returns heading into it. If this was zero, this is a 15% decline. This is a 10% increase to get us back to zero.
Yeah. And then I think Tom's responding, but this question he asked it about crypto. It's in the chat, but I think it applies for like any like speculative asset outside of like what we would manage in a portfolio. If someone wanted to take like a 1% flyer on any speculative asset, and then it were his logic, the exact question was, does it make sense to have a 1% flyer? In this case, he said crypto, but in anything. And if it takes a 10x increase, just take the gain and go back to 1% and wait again. And again, we're not going to go down the crypto chain here, but just in general, what are your thoughts on someone doing that with any kind of outside or speculative asset?
Yeah, absolutely. And so exactly that concept is, like I said, the extent of most of the academic and independent research is exactly that. Hey, if it's valueless, you lost 1%. If it 10x's, that position could create a 10% return off of your total portfolio using just a 1% allocation. In terms of how we determine whether or not someone should or should not do that, all of our wealth management, investment management clients have completed very comprehensive financial plans before they ever start investing. An important part of the financial plan is calculating a distinction between what we call core capital and surplus capital in your financial plan. For somebody who has a very strong financial plan, the assets that they actually have likely exceed the amount of assets that they would need to sustain their lifestyle adjusted for inflation over time. And that would be based off of, a historic 4% withdrawal rate or whatever it may be. The core capital is how much money do you need to sustain your lifestyle. The surplus capital is any amount of assets you actually have in your investment account above and beyond that amount that you need. And so that core versus surplus capital conversation is important to us because we like to say with the surplus, whatever amount of assets you have above what you need to sustain your lifestyle, you can buy speculative investments with it. You can buy crypto, you can buy private equity and private assets and venture capital if you wanted to. You can give it away to your kids, you can give it away to charity, you can light it on fire in your backyard. It will not impact your financial plan because it is above and beyond what you need in your core portfolio to sustain your expenses for the rest of your life anyways. So when discussing with a client of, hey, why shouldn't I just, take 1% and, go big with something like a crypto allocation, we want to make sure that there is surplus capital. And if there is, absolutely, it gives permission to gamble and speculate a little bit. Somebody who does not have a strong financial plan, they are playing catch up. We would not encourage that person to try and get ahead and play catch up in their financial plan with speculation, because the risk of losing that 1% you allocated and having it amount to nothing and end up valueless, the risk there is considerably higher. If you're trying to play catch up and you're behind, you do not have the surplus capital necessary to take any sort of speculative positions.
Awesome. Thank you so much. I think that was good because it's not just about crypto there. It kind of is more of a broad flyer for, as he alluded to, for other speculative investments. All right, guys. Thank you all for taking the time. We really appreciate it. And Nathan alluded to, if you have any questions, you've got our email information. You can contact us with any questions at any time via email, over the phone, and what have you. So we really appreciate y'all for being on.